for a quick topic today. Um, I just wanted to go over some options for financing for people who happen to be retired. This pops up from time to time, seems to come in waves, and I wanted to do some stuff that we can offer, but then I also invited Mike Galatis from Fairway Home Mortgage on here as well, and Matt Kirschner is a financial planner. Um, I'll turn it over to them in a little bit. Actually, we'll turn it over to Mike in a little bit because he wants to go over some options for reverse mortgages, which is something that we don't handle at Lenders End. And that's really all that Mike handles these days is reverse mortgages. So, and that's really how it should be. Anybody doing a reverse mortgage, that
Mm.
should be their main niche because there's a lot that goes into it. So, just not something that we handle, and we probably won't in the future. So, before we get into any financing options, we have to start with the most important thing of the day. Let me see here. And of course, my page down button doesn't want to work. But we have to say congratulations to Kathy Brogan. Because
Yes.
Kathy
Thank you,
won,
Ray.
Kathy won her NCAA pool. She had the Florida Gators. So
Yeah, baby.
big week for noted sports fan Kathy Brogan. So
Yes.
congratulations on that.
Thank you, Ray.
You're
Wow, that's
welcome.
such an honor for me. Appreciate it so much. I'm glad we are
I know you love
recording.
your accolades, especially when it comes to sporting events.
That's it. Right, you got it.
All right. So what I wanted to go over first is something that so we can handle. So when clients are retired, a lot of times we see this scenario, and I had this from last year. I wanted to kind of share. So these guys reached out, both retired. I think they were both in their late 60s, early 70s. So husband was making about 2,400 bucks a month for Social Security. The wife was making about 2,175, and then combined, they had a couple of pensions of about $3,100. So in total, they were making on paper about 7,675 per month. Um, Problem is they were looking for an $800,000 mortgage. So for an $800,000 mortgage, that monthly income just wasn't going to cut it because we have to look at, not only the principal and interest, but property taxes, home insurance. In this case, these guys were actually looking for high-end townhouses. So a lot of the places that they were looking at had condo fees of six, seven, $900 per month. So they just weren't showing enough income. But like a lot of people that are retired, they're heavily weighted in assets. So one of the things that we discussed doing with them is doing a draw on their retirement. So Fannie Mae, and Freddie Mac has a version of this as well, but Fannie Mae would say that you can use a monthly draw from your retirement account as long as you can show that that monthly amount that you're going to draw is going to be able to be drawn for the next 36 months. And a lot of these programs would require that the people be older than 62. So in this particular case here, what we did is we talked to the clients, we talked to their financial planner, and we came up with initiating a $7,000 a month monthly draw off of their IRA. So we can now use that as quote unquote monthly income. So when we take that $7,000 draw and we add it to the $7,675 that they were making on their Social Security and their pension income, that was now enough income to qualify for their $800,000 loan. So basically, the calculation that we did is that we had to show that they had at least $252,000 in retirement because we needed to see that $7,000 a month draw for the next 36 months. So in their case, I think they had about $400,000 in one specific IRA, so they met that requirement. So this is important because this comes up a lot with retired people because they don't, they're so heavily weighted in retirement assets that they don't necessarily think about qualifying for a mortgage. In these days, when you qualify for a mortgage, everything is done on a monthly breakdown. So we have something in the mortgage world that's called QM. It's called a qualified mortgage. We have to show that your mortgage payment plus your other bills, such as car loans, credit cards, student loans, we have to show that they're no more than 50% of your monthly income. So this is a way that we can help people that are retired to, whether they're already doing a draw or they want to initiate one, we can help create more monthly income. So Matt, I figured I would just reach out to you. If this was a case, let's say that this was your client, um, how easy is it to change or initiate a draw with your clients at Edward Jones?
It's pretty straightforward. I mean, the process isn't well known. It's called a 72T systematic withdrawal. So typically speaking, you're going to set the specific amount that you want to pull. It's scheduled, and this is most important if you're under, that certain age where you really need to draw from the IRA. So sometimes this works for someone that's retired at 60,
Hmm.
and they just want to show the income now because they have access to the assets, but they don't want to be penalized for drawing early. So pretty straightforward process. Once I think the hardest part is that it's pretty established. You're not really able to take more. You're not able to stop it. Once you start it, it's just systematic and it can be reported and treated like income.
Hmm. Perfect. Excellent. Um, so let's see. So that this is probably the most popular way that we see this done with retired people. Now, there's a second way, and this is there's a lot of different ways that we can do this. A lot of different lenders have different variations of this, but you can also use what's called an asset depletion method. So in this example, this would be for people that have a lot of assets behind them in retirement. So let's take for example these people here. They have $3 million in total retirement accounts. Well, rather than initiating any draws or looking at any draws that they might do, some lenders will allow you to take that total amount and divide it by either 240 months or 360 months. And then we can use that as, again, quote unquote income. So, go back to that example I gave you before. If the people were really making about, 76, $7,700 a month on their Social Security and pensions, and they had assets like this, we could just simply divide it by the 240 or the 360, depending on which mortgage program they were going to do. And we're allowed to use that as monthly income. So the one thing that's important to point out here is that in either of these methods, if the people are tapping into that account also for down payment money, we have to do all these calculations after that down payment money has come out. So that's one place that a lot of people will tend to forget. So if these guys wanted to pull out, $500,000 to use as a down payment, I would have to, instead of using 3 million to do this calculation, I'd have to back out the 500,000 and do the calculation off of the 2.5 million. Any questions on that at all? All right. So, nothing that you guys need to really know going forward. It's really just something to kind of keep, in the back of your mind. If you do come across that retired person that, reaches out, wants to take out a mortgage, it's just one of those things to remember to have them reach out to their mortgage person. If that's me, that's great. But, if they're having that conversation with you and it comes up that, we've got a lot of equity in our house, we've got a lot of assets, but we're retired. You just want to have that little bell go off in the back of your mind to say, make sure you're reaching out to the mortgage person to go over all of this to make sure that you're in good shape for when you need to get the pre-approval letter. So at this point here, I want to turn it over to Mike Galatis because Mike is going to tell us that you can also do a reverse mortgage as a purchase. So Mike, take it away.
Thank you, sir. And thank you so much for the opportunity to be here today. Yeah, so what we try to do at Fairway in the reverse lending division is really educate seniors and realtors alike to let them know that if for whatever reason you don't presently qualify for conventional financing because you're on a fixed income and maybe the first option with maybe you don't have the option of asset depletion. There is an option to purchase a home with a reverse mortgage. And it is based on the youngest borrower's age who will be purchasing the home. That's their down payment. And the good news is no monthly mortgage payments are required. So essentially what they do is, and I would say really how we help them is at the beginning of the process, when maybe they go to Ray for conventional financing and they've exhausted all of their options where they really no longer qualify. And they feel as though their only option may be to sell and rent. And that's where we're able to show them, based on a reverse mortgage financial assessment, which is different than conventional financing, that they could qualify potentially with a down payment from the net proceeds from the sale of their home. And when they purchase the home, the principal and interest mortgage portion of their payment is not required. And Ray, I did find a recent transaction we did. I don't know if Kathy, I'm able to share the screen, but this might help it out a little bit.
Awesome.
Yeah, you should be able to.
Alrighty, give me one moment.
There you go.
Can you see the screen?
Yep.
Yes.
Okay. So, and I believe they closed in October of last year. But we had a couple who were in their 70s. They sold their primary home for 1.2, and after their costs and their payoff of their current mortgage, they cleared about 618,000. They wanted to move to a town closer to be next to, I believe, their daughter. And they purchased a condo for 850,000. Their goal was to, in their retirement, to sell their home, purchase a new home, but no longer have a mortgage payment. But they didn't have enough to be a cash buyer. So we had them apply for the reverse mortgage for purchase because it is a condo and because it's a home equity conversion mortgage, which is the program we use for purchase transactions. It is an FHA loan, so we were able to get the condo association FHA approved. They made the minimum required down payment of the 850,000 purchase, and that was based on, again, the youngest spouse's age. So they had to put down just under 490,000. But that left them with 128,000, which I believe they chose to invest with their planner. So although I know there are a lot of cash buyers out there in today's market, especially Boston proper north, but if you have that client when you're out on a listing appointment and they tell you they're on a fixed income and they advise you that they've exhausted all their options for conventional financing, ask them if they've heard of H4P, or a home equity conversion mortgage, that are known as a HECM, but a HECM for purchase, where they can use the net proceeds from the sale of their house, or a portion of their net proceeds, I should say, to buy a new home, not have a mortgage payment, not be a cash buyer, and potentially have residual net equity to reinvest. And we're starting to see a lot more of this to be more common in the marketplace for seniors.
Hey, Mike, are they always, the reverse mortgages, are they always backed by FHA, or are they different versions?
So that's a great question, Ray. So there are proprietary reverse mortgages that are not backed by HUD. The HECM, or the home equity conversion mortgage, I would say is probably 97% of the reverse mortgages that are now done in this country. And a lot of it has to do with, in 2015, the federal government overhauled the reverse mortgage platform to ensure that seniors who are a protected class are truly protected. And so there's a lot of features to the HECM that's really in favor of the senior, and one of them is non-recourse. It's a non-recourse feature, which really protects them from always remaining in their home, regardless of how long they live, whether or not there's a market correction and there's there's a depletion in equity or value in the home, because if it's a HUD insured home program, they can never be removed from the home as long as they maintain it as their primary residence.
Did they still have, is there still a requirement that when you're doing the application and all of that, it has to be in person? Any sort of rules and regulations around that?
So there is, I will say it's not required to be in person.
Okay.
I will tell you that I meet in person, probably at the kitchen table,
Yeah.
of 99% of seniors that are interested in taking advantage of the home equity conversion.
Awesome.
They are required, but that's a great point, because they are required to take independent third-party counseling, which up until COVID was always in person. So there are HUD counselors, HUD approved counselors that we can provide, or they can go to the HUD website to find a list of counselors. Up until COVID, it always had to be done in person. Right now, they're able to do that over Zoom or over the phone, but we are being told by the state of Massachusetts that will probably end before the end of this calendar year, and we'll have to go back to being counseled in person. Right now, when they're counseled, it's probably less than an hour on a call.
Oh, that's good. Nice.
Yeah.
Awesome.
Yeah. The first thing we try to do when qualifying Ray, a senior, and again, it's really when they've exhausted their options of conventional financing, we try to find out their why. Why do they think they need the reverse over conventional? And most of the time it's because they don't qualify, they don't have the asset depletion option. They don't have the option of increasing their distributions through their retirement. And it's a great way for them to take advantage of right sizing or downsizing and not having a mortgage payment.
Yeah, I think something like this, I mean, even with the ones I mentioned before, and especially this, it's just, I think it's so important that if, agents are on listing appointments or meeting people that are retired and downsizing, to really have them reach out to, the mortgage person and their financial planner as early as they possibly can. Because especially with this, I mean, the reverse mortgage, even for me being in the business on the forward side of things, I don't know a ton about the reverse mortgages, and I think a lot of the agents would be the same. So I mean, that's usually something that we wouldn't be able to explain to the home seller. Someone like you would really need to step in. I think the more info they get on something like this up front, weeks and months before they're even ready to list the property in MLS, they would really need a thorough meeting on something like this.
Yeah, you're right. And from a realtor's perspective, it really is one more tool in the utility belt, because, and especially if you have the SRES designation, or you in general just work if the realtor works with seniors, when they go on that listing appointment, and and when they're determining what their wants, needs, and goals are for selling their home, more often than not, the biggest concern is being retired, being on a fixed income. Do they qualify for conventional financing? And if they don't, will they need to stay in that home, or they need to sell and potentially rent? And again, I would say this is a plan B or a plan C option for many, but it really gives that realtor the power to help a senior, exit the home that really maybe can no longer viably live in and get them into a home that's better for them.
Awesome.
Yeah.
Excellent. Anything else to share on that one?
I have some questions.
Sure.
Yeah.
Sure.
Okay. I actually have 3 questions. I can kind of spew them off and you can answer them.
Yeah.
So I'm curious about what the interest rate is for a reverse mortgage.
Mhm.
Also, I just happen to know somebody who years ago took the reverse mortgage, currently in a nursing home. Now it was a two-family house. And the daughter and kids live in one unit. And I think the mother is still in the home. The father is in a nursing home. Is there any opportunity for refinance? Or, I mean, it's my understanding that the person who takes that reverse mortgage, if they are no longer able to live in the home, regardless of who's still in the home, if it's their mortgage, they have to pay that off. They're sort of a due on point. So
Yeah, so
those are my
that's
questions.
so there the easy answer is to question number one. Um, the home equity conversion mortgage interest rate is very similar to what prevailing conventional 30-year rates are at. However, the home equity conversion mortgage is an arm. So I think yesterday our HECM was at 6.5%. But it is technically an adjustable and it could adjust. But really the baseline we use when we have clients asking what the rate prevailing rate is, it's the HECM is always very close to where a conventional 30-year is. So I'd say today we're at 6.5. Your second question really is a phenomenal question because in 2015, HUD stepped in, or the federal government stepped in and really made changes to the program, because prior to 2015, if you held a reverse mortgage and you were what was considered a trailing spouse, meaning in this case, maybe the husband who's now in the nursing home had was the only person on the application for the reverse mortgage. If this was done prior to 2015 and he did go to a nursing home, technically, if he can't occupy that residence any longer for at least 6 months a year, that house would have to be sold. After June of 2015, the federal government changed that regulation, whereas if there is what's called a trailing spouse, meaning the wife is still in the home, she was never on the mortgage, she can never be removed from that home because she is the spouse of the person who took out the reverse mortgage, even though he is no longer capable of residing in that home as a primary residence. So as long as she is alive, and assuming this is a HECM and assuming it's past 2015 when they took out the mortgage, they really don't have to sell the home. I mean, as long as she is as long as she's the trailing spouse and she's still occupying it as a primary residence.
So when you say as long as it's a HECM, so it's a HUD-backed program, correct? So obviously reverse mortgages have kind of a predatory reputation.
Yes, they do.
And so what happens if it's not that? What is the other kind of products out there, or are there things that we should, warn our clients against working with certain programs or something?
Right. And again, we're just focusing today on Tara on the home equity conversion mortgage. I would
Okay.
say a lot of mortgages after 2015, if they're not a HUD-backed insured loan, we call those proprietary. And I would say more of them than not would still have that trailing spouse option. I would say every loan program, just like conventional and forward mortgages, uh, they all have their own program guidelines. So the folks that are interested in taking out a reverse mortgage, whether it's HUD insured or not, the question you're asking me right now are the exact same questions that they, as the homeowners, should be doing their due diligence in asking.
So Mike, it sounds like when you say proprietary, so I think you mentioned like probably 97% of the HECMs are all, HUD based. But the other 3%, let's say if they're proprietary, that's almost like portfolio in my world, correct?
Yes, so that's
Yes.
exactly correct.
So
So you
same
could,
thing.
you
So
could,
yeah, so if somebody's doing a portfolio loan, then they need to look into, does it have a prepayment penalty? Does it have this or that? Is it an adjustable? So I think the same thing in the reverse world would be if it's not HUD based, not that everything's out the window, but you've got more to check into to make sure that you're hitting all those guidelines.
right. And to the point, Tara, when we talk about interest rates, if it's not a HECM, we see most of portfolio or proprietary products in the reverse arena, when they're not HUD insured, they're double digits in rates.
Oh.
So they're not, they do give you a little bit more flexibility with funds you're able to take, but it's at a higher cost. And that's why I would say 97% of the reverse products today are done under the HUD umbrella.
I have one last question.
Oh,
Is
sure.
there a particular age? Like you have to be so old to even take this product, take advantage of this? Or can you be a 31-year-old with $500,000 of equity and say, I don't want to pay my mortgage, so I'm
Yeah,
going to do this?
no, great question. So the primary borrower, at least one borrower has to be 62. So again, if you have a spouse and that trailing spouse is maybe in their 40s or 50s, you are still eligible for a reverse mortgage, providing one is at least at the minimum age of 62. Great questions.
Thank you.
Oh my
Awesome.
gosh, you're welcome.
Can I ask some 3 questions too? I
Yeah.
think they're quick, I think.
Oh, that's okay.
I'm just curious, this trailing spouse thing, I find fascinating to be called the trailing spouse, but
No,
anyway.
I know. And
I
I'm
think,
trying
aren't we all trailing spouses at some time? But now, with respect to your example, the example that you cited said the husband had signed the application and the wife did not. So my question
Right.
is, if both of them had signed it, he's in the nursing home, is she still considered a trailing spouse in the home?
Yes, and
Okay.
my apology because I
No,
am
that's
using
okay.
internal lending language, but prior to 2015, and like Tara had said, there's a negative stigma to reverse mortgages.
Yes,
And
completely.
the reason being prior to 2015, if and I wasn't in the mortgage arena, reverse mortgage arena prior to 2015, but there were a lot, the programs really favored more the lenders than they did the homeowners.
Mhm.
And
Mhm.
after 2015, that really changed. So prior to 2015, if it was just the husband, let's say, could only qualify at the time,
Mhm.
and if that spouse was not on the mortgage and that primary applicant who took out the reverse mortgage no longer could have retained that home as their primary residence, that spouse was out of luck. They had to sell the
Yeah.
home, even if the first one
Yeah.
went into the nursing home. They
Wow.
had to leave. And
Wow.
you know, the government recognized that probably really wasn't a good idea. So after 2015, and I would say most portfolio lenders do follow suit with the remaining spouse in the home where they can never, as long as they retain that home as their primary residence, they could live to 120. They cannot be removed from that home.
Okay,
yeah.
second question, all property types open for this? So,
Yeah, great question. Everything except for co-ops. We
no
and I am
co-ops,
sure
okay,
this and they're not really prevalent in
yeah,
Massachusetts, but they
yep,
certainly are in New York. Um, but yeah, I mean, obviously, if it's a condo, just like a forward
yep,
conventional, Ray will tell you, you know, we got to get that condo association HUD approved, but that is something we do internally. But
okay, and
multi-families,
sorry, go
no,
ahead.
that's fine.
My last question was, do credit scores factor into this at all?
That is a great question because they do not.
Oh, they don't, okay,
So the financial assessment, Kathy, on a reverse mortgage is different than conventional. And that's why
okay,
at the beginning of my presentation, I almost said, not that it's a last resort, because there are folks out there who may have great credit, or
mm-hmm,
may have you know, a lot of money in their retirement portfolio, but really don't want to touch it because of its earnings. That's when we really see folks take advantage of the reverse mortgage for not having a payment.
gotcha. Okay, that was it, thank you.
You're welcome. Great questions.
Good info. Awesome. Appreciate it, Mike. Thanks so much. So
Welcome.
Matt, I know I invited you on this Zoom probably like 5 or 6 weeks ago. I didn't realize, what we'd be in the middle of today. But I just checked and the Dow is green. We're up
Yes, it
two.
is.
We're up two. So I don't know if you wanna hop in to do a quick commercial and kind of, what are you telling your clients and what are you telling people that are looking to buy or sell right now?
Yeah, so I mean, particular to real estate, I think we're all probably aware how fortunate we are up on the North Shore here. The values have kind of really held and continue to increase. So having conversations around 72 Ts and 60-day IRA rollovers and talking to you and obviously talking to Mike about potential reverse mortgages as an option as well are all good things. With regards to the market, yeah, I mean, it's been a challenging 5 days. For me, generally speaking, tried to position clients, in the fourth quarter, coming into this because just history tells us, we don't generally get 3 amazing years in a row on the S&P 500 or the Dow. And trying to de-risk, the concept of kind of protecting what you have, locking in gains as much as possible, managing taxes as part of that process too. And then second order of effects is kind of having an emergency fund, having some liquidity, having dry powder for events like this where it's actually, you feel better, you feel more confident because there's a potential buying opportunity on the other side of this. Initially, last week, a lot of the pain was in the tech space and communication services and consumer discretionary, but some of the other sectors were still positive. Utilities, staples, healthcare. The last couple days, we've started to see even a rotation out of bonds, which was a big flight to safety trade again last week. So it's gotten a rockier. But again, just always trying to talk to clients about positioning. You don't want to panic sell. You want to have that emergency fund. You want to understand your time horizon, and then it's just kind of managing the risk. So it's been fun. It's always something new and something different. This one feels a little bit more self-inflicted than, let's say, 2007, 8, and 9, and 2020 and 2022 when rates went up. So I've seen several of these now, and I'm sure I'll see more. But again, it's just trying to keep clients confident, position, and if they don't need to sell, if there isn't a liquidity concern or issue, to try to be a little more patient.
Yeah, I think that's what it's going to be. On our end of things in the mortgage world, we're always watching the 10-year treasury, and that's been on a wild ride since last
Mm.
Thursday. So hopefully we'll see some flight to quality, like you said. Maybe the more the 10-year Treasury goes down, the better rates we'll get, which is I think what we're all still hoping for. So, well, I've got Matt's information up here and Mike's as well. So if you guys have any questions, definitely reach out to them. I appreciate you guys taking some time today to jump on this. And if anybody has any other questions, we'll be good to go. Otherwise, we will wrap it up and get back to it next week.
Great. Thanks, Ray. Thanks, Mike.
Awesome.
Thanks,
Thank you
Kathy.
so much, Ray.
Great.
Appreciate this.
You're
Thank you.
welcome. Thanks, guys.
Yeah, thanks, guys.
Have
Thank
a good
you.
week. Take care.
Bye-bye.
Take care.
Thank you. Have a good day.